So
Hey guys, this is Joe from New York Trading Room. I'm looking to short OC Yen 80.28.
Post-night at the New York Stock Exchange, Morgan Brennan is on assignment, coming off the worst 2 days for the S&P since October of last year, and markets trying to find some bargains in what are some oversold conditions, up 1% on both the Dow and the S&P, although we're looking for potential reversals as we got yesterday.
Yeah, it's too early to say at this point in time because we are 30 minutes into the trading session. Here are the three big movers we're watching today. Snowflake shares popping after the company reported its software sales more than doubled for the quarter and upping their guidance for the full year. Boeing shares also in the green this morning after China's aviation authority issued a directive that would bring the company's 737 MAX planes back into action after more than 2 years. And finally, keep an eye on Apple, hitting an all-time high yesterday, but demand concerns are weighing on the stock this morning. Yes, you heard that right. Demand concerns. More on that story in a moment.
All right. First, though, let's the volatility is continuing here in the in the markets after the U.S. confirmed what is the first case of the Omicron variant. Let's get to Meg Terrell now for more on that and just exactly what we may have heard in the last 24 hours, Meg, because certainly the market is paying very close attention.
Yeah, David. So this first case in the United States of Omicron makes the U.S. at least the 29th country to have identified a case of this variant. Here in the U.S., the person is in San Francisco, returned from South Africa November 22nd, tested positive the 29th, was fully vaccinated, but didn't yet have a booster. They'd had the Moderna vaccine less than 6 months previously. They had mild symptoms and have recovered, we heard from health officials, and their contacts have been traced. So far, everybody has tested negative. Now, this, of course, as concerns are mounting around the world about the impact of Omicron, the European CDC saying based on mathematical modeling, they expect that Omicron could cause over half of all SARS-CoV-2 infections in Europe within the next few months. In South Africa, we are starting to see a real evidence of a fourth wave starting. See that spike there at the end. When Omicron was first detected last week, that was just a real small uptick, but it really is continuing in that direction. World Health Organization officials briefed this morning on what they're seeing and particularly what they're looking at in terms of the ability of this variant to reinfect people who have already had COVID. Here's what they said.
We monitor these reinfections for the Beta and for the Delta wave, and we didn't see an increase in reinfections over and above what we expect when the force of infection changes, when the wave stops. However, we are seeing an increase for Omicron.
So that's something different about this variant, but they do say they hope that having previously been infected will provide protection against severe disease or death. But guys, all of these questions still outstanding, and we are hoping that by the end of next week, we'll start to get some answers. Back over to you.
Yeah, Meg, real quickly, given so many questions, as you say, without really actual answers, a lot of anecdotal things. Is there anything specific, though, to South Africa and the population there, perhaps, that can't necessarily then be inferred for the rest of the world?
Definitely. So it's a younger population in general. It is not a population that is hugely vaccinated, although perhaps more than other countries in Africa. What we are hearing about right now is a lot of younger people who are getting sick, but it's not clear, of course, if that's because those are the folks who are out mixing more, those are the folks who are less vaccinated. And so there are just so many questions about the data. It's really hard to draw conclusions. I mean, it's great news that the one case in San Francisco was mild, of course. We'd all love to think that's going to be the case, and hopefully it is, but we need more epidemiological data from around the world
Looking
to really
to short
know.
Euro Aussie, 145.35.
All right, well, we know you will be on it, Meg. Thank you. For more on Omicron's market impact, Richard Bernstein Advisors Dan Suzuki joins us now alongside JP Morgan Asset Management's Phil Camparelli. Thank you both so much for being here. Dan, let's start with you. It seems like at least today the market is clinging to the bit of good news that's out there with regard to the ability for therapeutics to treat this and vaccines' ability to kind of combat this as well. Until we do know more, as Meg was saying, should we just expect more volatility in the markets?
I think that's probably right, Leslie. I think it's not just Omicron. There's a lot of variables that the market's having to digest right now. A lot of those variables come with a lot of uncertainty and potential downside risk. I mean, you talk about Omicron, there's the Fed increasing the pace of its tightening. There's, issues around, fiscal slowing impulse there. So there's a lot to comprehend right now. Ultimately, I think, this is really going to be a short-lived risk to the market. So I think you're right, and the volatility is probably going to be sustainable long term. But I think if you look through this, you mentioned therapeutics. I'm actually quite bullish on the outlook for the recovery from COVID and just the overall recovery in general. So I think the reaction you're seeing today in markets makes a lot of sense to me.
Phil, it seems like your colleagues at JP Morgan
looking to buy pound yen around 160.25. 20 bips of stop loss and 40 bips target. Also looking to go long Aussie yen, 80.15, 20 bips target and 40 bips stop loss, 20 bips and 40 bips target. So pound yen long in this area, 150.28. Aussie yen also looking to go long, 80.15. 20 bips stop loss, 40 target. Pound dollar, we're looking for short. Euro dollar, let's remove euro dollar. We get pound dollar is better. Looking to go long, pound dollar 133.03. $20 pips stop loss and 20 pips target. And you can see we're taking the stronger currency against weak currency. Let's see pound CAD. Pound is strong, CAD is weak, so we're looking to go long pound CAD. So any pullback in pound CAD, I'm looking to go long. Around 70.32 in this area here with 20 pips stop loss and 60 pip target. And if I see any new trade, I will let you know.
Because of high inflation is. You're getting zero on cash nominally, and with the last CPI report in October, you've just gotten a negative 6% real return on cash. So, we're asset allocators, and the overweight to stocks is validated, in our opinion, driven by the fundamental story, driven by the consumer, and driven by the fact that even if the Fed does speed up their tapering, we're so accommodated right now. There are miles to go before they get anywhere near normal. And again, just to define it, tapering is less easing, it's not tightening, right? And that's a big deal. So it's hard to take the other side of that, Leslie, which is why we continue to lean into stocks here.
Yeah, it sounds like you and Ray Dalio of Bridgewater share that same sentiment, that cash is not necessarily where you want to be right now. Dan and Phil, thank you very much. Appreciate it.
Meantime, we're keeping an eye on shares of Apple. They hit a new all-time high yesterday, but as you see, they are under pressure this morning. This follows a report that the company has told suppliers of waning demand for the iPhone 13. Let's get more from Goldman Sachs' Rod Hall. He just reiterated his neutral rating on the stock. But Rod, I'd love to just start off with your take on this report, based at least on the data that you collect regularly in terms of trying to assess demand.
Yeah, good morning. Well, we get these reports often, and I think I heard somebody say earlier, I don't get a phone call from the suppliers telling me what's happening with Apple. I think we have to take all these things with a grain of salt. And let's say it's true, it's hard to interpret these tea leaves in this environment with the supply chain so tight. And in a normal year, I would say this would be a likely negative demand indicator. In this year, I think it's very tough to tell.
And that is because what? I mean, the idea that Apple perhaps may have ordered more than it necessarily needed just to make sure it had the chips it needed on hand?
Yeah, they may have over-ordered. Typically they will over-order in any year. This year, they probably over-ordered by more. So supply chain reductions may be an indicator of negative demand, maybe not. I would say that our own panel, we do our own looking at lead times for iPhone across the globe. That has suggested demand may be weakening. Lead times are always the balance of supply and demand. We've seen China lead times come in faster than we thought they would. We've seen U.S. lead times come in faster than they thought they would. And in this latest week, which we just published, we saw the UK and Europe come in by about 7 days. So, lead times are suggesting that demand has been a little bit weaker than we might have expected. The iPhone 13 Pro in particular has lead time data that's quite a bit lower than it was last year. And you would have thought with supply shortages, that would have been the other way around. In fact, the only iPhone that actually still shows elevated lead times is the Pro Max. So, that data suggests that demand's a little bit weaker, but again, it's very tough to tell in this environment.
Right. Well, is it weaker? I mean, I also see you say demand coming closer to equilibrium. I guess just to try to understand where you think we're going to end up here in terms of sales during this important period that we're in right now.
Yeah, let's take the iPhone 13 Pro, for example. If you're short of supply in this environment, which I think we all assume that they are, and your lead time this year is lower than last year, then you're probably concluding that demand there is weaker than it was last year. Okay, so that just logically, that's where you're going to come out. If in the case of the other devices, your lead times are pretty similar to last year, there it's less clear because you don't know how much supply has come up to meet demand. So I would say that, on the margin, the data suggests that demand's a little bit weak here, but I think it's very difficult to tell, as you can tell by the way I'm talking about it.
Difficult to tell exactly how weak, perhaps. Even with the sell-off this morning, Apple's still trading about 11% above your price target. Would you urge investors not to buy on today's dip?
Yeah, we're neutral as stock. I mean, if we wanted people to buy on the dip, we'd be buyers. I think that our view has continued to be that the number of subscribers that Apple's got, the number of users out there, that growth rate is slowing to GDP growth. And the ARPU, the revenue per user, headed into COVID was flat. It jumped by over 20% in COVID. It's likely going to normalize at a lower level from here. Very tough for Apple to grow earnings and revenue in that scenario. So, yet the stock is priced at a significant premium to the S&P 500. So, yeah, we don't think people should be buying this stock, and that, given all of those data points.
So, Rod, neutral rating here. What would make you feel otherwise, particularly in light of the fact the stock has obviously moved up to perform in line, frankly, this year with the S&P after underperforming much of the year?
Yeah, and by the way, inline performance is neutral. So that's done exactly what we thought it would, and it's very consistent with our rating. To get more constructive, I would want to see some evidence that ARPU is holding up the way the street thinks it will at levels that we saw in COVID, that we believe were driven by the lockdowns and the fact that consumers just had a lot more money to spend because they weren't spending on restaurants and travel and things like that. If I were going to get more cautious on the stock, I'd want to see the ARPU undershooting me or significantly undershooting the market. So, that's kind of the way we think about the stock. We're looking at that ARPU, we're looking at the trajectory of the ARPU, and then we make our calls accordingly.
Okay. Rod, always appreciate your insights. Thank you.
Yeah, thank you.
As we head to a quick break, here's a look at our roadmap for the rest of the hour. More on how to play the Omicron trade, from airlines to crypto. Where should you be putting your money?
Plus, it has been 2 decades, that would be 20 years, since Enron declared bankruptcy. We're going to be live from Houston with a look at that legacy.
And finally, pandemic mortgage bailouts are coming to a close, with more than 1 million borrowers behind on their payments. We'll discuss what it might mean for the housing market. House Financial Services Committee announcing a hearing to address D.C.'s growing demand for crypto regulation. Top executives from 8 major crypto firms are set to testify. Joining us now is one of those CEOs, Paxos co-founder and CEO, Chad Cascarilla. Chad, welcome back. Good to see you again.
Great to be on. Thanks for having me.
What do you think? How do you think the House is going to try to frame this discussion? What is this about?
Well, I think there's probably a couple different angles. The first is how is our financial future going to be different? How is this technology changing all of our lives? Why is it important? How is it able to create access in different products? Also, it's going to be about the dollar and how the dollar is changing, and the type of product that the dollar represents is shifting. How people use it, what their daily lives look like, why it's important in order for the U.S. to maintain its financial primacy, in order to be able to adapt to the changing world. So I think those are going to be a lot of the key themes here. I think everyone in the industry wants clarity, certainty, and consistency in terms of a regulatory parameter and a perimeter in order to operate. And I think that will really help make the industry be able to operate in a way that everyone understands from the financial services industry today. And so these are some big topics. There's a lot to talk about. I think we'll get through a lot of those, but it's an ongoing conversation. The Presidential Working Group paper was an example of exactly this type of conversation unfolding in the public domain.
Yeah, you sound like it might be more of an opportunity than, say, being defensive that the hammer is going to come down.
I personally think it is. Well, certainly in the case of Paxos, we've always embraced regulation. I think we're probably the most regulated company in the entire space because we've taken a ask for permission approach from the very beginning. And we did that because we felt like this technology could fundamentally shift how the financial system works, create societal-wide outcomes. And in order for that to happen, you need regulation. It gives a stamp of approval. It also creates a real sense of consistency. And so I think that it's important for there to be regulation. And what we really want is consistency, clarity, certainty. How can you operate? What are the rules of the road? And I think that's a lot of what we'll be able to flesh out in this conversation next week.
Chad, what types of regulation do you think need to be prioritized here? To your point, there are a broad set of issues. Congress is getting up to speed on this. What would you urge them to tackle first?
Well, there's a couple different components. The first is, in the crypto markets, there are assets, there are securities, and there's kind of some gray areas. Really getting into understanding where is that gray area going to fall out. And today we don't really know. We know Bitcoin is an asset and it's safe. And then after that, it starts to get a little bit more murky. And having some consistency would really help, I think, the industry in significant ways, because it would make clear what are the type of regulatory approvals that would be needed or might not be needed. And there's also, I think, an important conversation today around how do you tokenize dollars and have that be safe? How can you have it fit in either existing regulatory frameworks or some new ones? The Presidential Working Group paper talked about this. And we've taken a tack where all of our dollars are basically cash and equivalents. They're held in U.S. Treasuries and T-bills, very short-term maturities. So there's no interest rate risk, no credit risk. It makes it very safe and it's highly regulated. There have been other ways of doing tokenized dollars, and they might create more risks and more uncertainty. Having those types of conversations and really helping to make it clear to members of the committee what our different business models are and how getting them right, getting the regulation right, getting the business models right, can really be a very, very important force for change and very important for the U.S. to maintain its primacy. Because really what's happening is our financial lives are totally shifting. They look totally different, I think, in 5 years than they do now. How can we make sure that we have a financial system that represents that? It's kind of implausible now that our financial lives look so much different than the way people are living their lives in a really digital-first way.
That's certainly the case that we expect you guys to make on the 8th. We'll be curious to see how the hearing goes, Chad. Always good to see you. Thanks for the time today.
It's great to be on. Thanks for having me.
Let's take a look at the stocks powering the S&P higher this morning. Kroger, we're at the top of the list there after some strong results. More on today's market action after the break. Stay with us.
about the stock market. And then I retired in 2018 because I was just absolutely sick of trading. I'd been doing it for 15 years. I was living in Bali where the stock market opens at 9:30 and 10:30 p.m. I was fucking miserable. So I basically quit for almost 2 years. Then coronavirus happened and I started dabbling back in the stock market. And then I realized the number to get why I fucking hate it because I can't stand trading at night. And then all of a sudden I started in crypto, started moving. And then I made my first crypto video in October of 2020. You can see here, pro stock trader versus crypto. I learned how to trade Bitcoin. And I did make $30,000 in my first 30 days. I was like, oh shit, these actually moved kind of like the stock market. Problem was, I did lose all that, 30K, in the next 30 days. So I was in, I was out, I was like, well, that fucking sucks. But the thing that I noticed is that all the kind of tactics that I was using to make money in the stock market was very similar to basically this supply and demand and price action in crypto. So that's when I kind of started going balls deep in crypto. And I didn't really just like throw a bunch of money in. I was like, okay, I'll open an account with 20K and see how it goes. And very quickly that 20K turned into a 6-figure account. Once I had 6 figures in my account, that's when it became much easier to start making 50 to 100,000 to upwards of $400,000 months in my portfolio. And also learned how
Now it's time for our ETF spotlight. Taking a look at the Energy Select Sector Spider Fund, ticker XLE, as oil continues its volatile ride this morning. Crude hitting its lowest levels since August, while natural gas is on pace for its worst week since 2014. Core Holdings, Exxon, and Chevron, two stocks that make up over 40% of the ETF's holdings, higher this morning as investors continue to weigh the potential impact of the Omicron variant. Shares of both of those names less than 10% from their highs.
Meantime, well, that's big news for airlines. Check out the names like Delta, up almost 6% today. Is now the time to buy names on a discount? We're going to discuss that after the break.
Nelson, I was like, why are my fucking positions being sold? And then so Kraken was selling all my positions for me. It sucks because I was like, now I'm taking losses on it because it had been over 28 days on my account. And so the ones that I did have on leverage, which were the ones that I fucking bought higher, of course, automatically sold out. And at least some are there. This is when I still had a pretty sizable position, but only cash and leverage in XRP. And this thing just absolutely blew up. And it blew up because it was in a kryptonite pattern. Kryptonite patterns are something that I teach inside of the crypto course, which is something that I also taught for almost 2 decades.
Welcome back. I'm Rahel Sullivan, and here's your CNBC News update at this hour. With daily cases now topping 70,000, Germany is imposing new restrictions on people who are not vaccinated. They'll only be allowed into essential businesses like grocery stores and pharmacies. If that doesn't increase the country's lagging vaccination rate, Parliament will consider a vaccine requirement for everyone, and that could go into effect as early as February. The Archbishop of Paris resigning. Michel Opati admitted that to what he called an ambiguous relationship with a woman in 2012. Pope Francis quickly accepted the resignation offer. Meghan Markle says that her court victory today against a British newspaper group is also a win for anyone who has ever felt scared to stand up for what's right. The publisher of the Mail on Sunday lost its appeal of a ruling that it violated her privacy by publishing parts of a letter that she wrote to her father. Markle says it's a precedent that could help shape a tabloid industry that conditions people to be cruel. And the 50,000 LED lights on the Rockefeller Center Christmas tree are now shining. They were turned on in front of thousands of people in 40-degree weather and millions more watching on television. Sure is a beauty. Carl, I'll send it back to you.
We got a pretty nice treat out here at the NYSE as well. Thanks, Rahel Solomon. Stocks are recovering after the worst 2 days for the S&P since October of 2020. But where do things head from here? Here to help break things down where we are, senior markets commentator Mike Santoli. Mike, your thoughts in light of the reversal yesterday?
Yeah. I mean, this morning, all we're really doing so far is responding to just how, in a very short-term basis, things did get pretty stretched to the downside with that liquidation near the close yesterday. We definitely have just used up some of that oversold power here. Still very much a market that probably needs to earn back the benefit of the doubt. A lot of things that you would look at to say, you know, are things so bad? Have they been so negative for this stretch of time that all of a sudden they're going to start to become good because they are so sold out? You're getting there. We're in the zone. If you look at the number of stocks making new lows, if you look at things like the options hedging activity, things like the volatility index, it's starting to look a little bit like we saw at other lows this year, not quite even as deep as what we saw in September. Let's remember, we had a 5% pullback for over 5 weeks in September into October, bounce from there. 4 weeks ago, everyone was saying, oh, the market's running a little hot. We got to cool off. Well, we've done more than cool off. So if we're in the same type of relatively low volatility mode where you do have some dip buying power, then you're getting in the area where it makes sense if the economic story hasn't changed radically for the market to find its footing. I do think those are big ifs, though, because we don't really know if earnings are still going to be on the same path that we thought before. And this year-end dynamic where a lot of the story stocks, a lot of the big aggressive growth names, all that stuff that was crowded on the hedge fund side has really not found a low yet, at least not one that you can trust. And that's a different dynamic this time than previous times when we were sort of hiding in the growth stocks when the cyclical sold off. That rotation has had some slippage here.
I'm glad you used the word zone because that's what FundStrat said last night. Zone of support between 4,500, 4,550. I always love tossing what technicians are saying to you. FundStrat's argument is don't trust anything really until we get to 47.03.
Yeah.
What do you make of that?
Well, that just sort of says that's more or less the closing high. So if you think the market has to basically match its best close or thereabouts before you say it's out of the woods, then that's the way you would read these things. I do think yesterday was telling that we spent a lot of time in the morning right around these areas just above 4,600, where technicians thought 4,640-ish, where folks thought that was of some relevance too. So look, I think that you have to just sort of redefine what represents traction levels and all that sort of thing. I will say, during yesterday afternoon, people that I follow and people that I talk to who are generally pretty good about the short-term tactical stuff were kind of caught off guard by that wave of downside we got in the afternoon. It doesn't mean there was anything odd or extraordinary about it, but it's just some of the clues that have worked before stopped working there. So I think you have to at least notice that.
That's good stuff, Mike. We're going to keep our eyes, obviously, on every tick today, as we have to, given recent experience. Mike Santoli, thanks. Meantime, the White House is tightening travel testing requirements and mask mandates as part of a plan to fight COVID-19 following yesterday's news of the first case of the Omicron variant being detected in the United States. Joining us today, former Continental Airlines CEO and chairman and CNBC contributor Gordon Bethune. Gordon, what a treat for us. It's good to see you again. Good morning.
Nice to see you.
I wonder, as we make our way through these various waves, Delta, now Omicron, if you're sensing a sort of degrading, lessening effect on bookings and cancellations as we learn about each new one.
No question about it, Carlos. People are moving short-term meetings out to April and May, trying to get on the other side of whatever hyperventilation is going to occur in the marketplace due to this latest variant. I know everyone has a different tolerance for fear, But it's almost Chicken Little running through without any substantive proof that we have a problem. But it causes immediate concern, and you're going to see that in December and January bookings.
So you think leisure we might see some hit?
Oh, sure, because a lot of leisure is into different countries in Mexico and the Caribbean and of course into Europe. All of these, Japan has cut 100%. So, I mean, all of the access to places is now in doubt. They change almost daily, so you really don't know whether you're going to get home if you go someplace. So you err on the side of conservative and just don't go. So it's had an effect already.
Do we get an echo of that in corporate?
Well, yes, sir, because travel managers, business, Carl, businesses hate uncertainty. And this is certainly an uncertain time where even the government doesn't know what to do. So they tend to react. I got to give our government credit for subsidizing the workforce so that Delta, American United, and Southwest were ready to go. Like November was a knockout month. But they kind of cancel all that out with this one hyperventilation, starting quarantines and different approaches to stem this flow of what? It appears to be a mild disease. I'm not sure. I don't think anyone is.
Do you think that stricter international travel testing would thwart plans abroad, or does it make people actually feel more comfortable getting on these kind of long-haul airplanes?
I think, Leslie, that's true, that it does make them more comfortable. It is a necessary step. I noticed they've stopped it from 72 hours down to 24, which makes it more onerous and difficult to make sure you get on that plane without, missing your aircraft because you didn't get your test finished. But, I mean, everything you can do to calm and placate the traveling public, I think we ought to do it. I just believe that having the vaccination is kind of the way to go, and that's the real main line of defense, and everything else is kind of corollary. These are nice to do, but I'm not sure they ought to be mandatory.
So assuming we do see some impact from nervous travelers, whether it's leisure or business, we do have oil offsetting it, and I know these are such crazy cyclical moves intra-quarter, but what would happen to the idea that we would see a continuation of quarters that are at least break even or are mildly profitable?
Well, I think that's very doable, Carl, and there's a tenacity in our market, because people, maybe you guys at the studio the same way, we're tired of it, and we've got a lot of scar tissue, but we're somewhat inured from the doom and gloom scenarios that have been painted, finding out that we've got a handle on it, it's kind of manageable, and we shouldn't just stop our life because of this. And I think there's some more and more of that every day.
Finally, we were talking earlier this morning about China issuing a directive for the MAX. Do you think that thing flies in China soon?
Well, it should. It's sad, Carl, when it's political, and you can't tell safety from politics because they shade it, but it's going to fly. It's a great airplane.
Gordon, we love taking advantage of your years of experience in the industry and your insight. Talk to you soon.
Nice to see you again, Carl. Pleasant.
Gordon Bethune.
Well, it has been 20 years to the day since Enron went bankrupt. We're live from Houston. We're going to look at the legacy of that company. That'll be next. Don't go anywhere.
Technology and our business model allows us to deliver the quality of video you see on the left through the open internet to customers worldwide versus the quality you see here on the right, which is what happens without our technology and our business model. And all of that happens here on the 44th floor of the Enron building in Houston, Texas.
To the tech sector, we take its lead as we approach year-end. One chart says it all on tradingnation.cnbc.com. More squawk on the street ahead.
Anyway, I wasn't here in the mornings, at least last week, so I wasn't able to update people on Enron. But I'm back, and there's still going to be a great deal of news, so we'll get to it right now. Enron, as was expected,
But Enron is gone.
Enron is gone, Mark. Enron is, you know, sorry, take a little laugh. Enron is in the pennies. You know, I was happy not to have been in the mornings because so many people were blaming me for Enron's demise. The old blame the messenger as opposed to listen to the message, which we've been giving people for quite some time.
Hey, if they'd listened to Kramer, they would have saved themselves $10.
Yeah. Sorry, I was looking at myself. You can't blame me.
You look the exact same, by the way.
I like her.
The exact same. It hasn't been 20 years.
That was 20 years ago.
Yesterday.
Actually, Leslie, yes, when you were 12, exactly 20 years ago, energy company Enron did declare bankruptcy. It was a stunning fall from grace, of course. It spawned a scandal, nearly 24 criminal convictions, and, of course, sweeping government reforms. Scott Cohn has a look at the legacy.
Mr. Jenkins, it must be evening there. Thank you.
20 years before Zooming was a thing, this Enron promotional video was touting video conferencing on the internet and streaming video years before Netflix.
Enron Communications is changing how the world communicates.
We're changing the industry. Scott Yeager was head of strategy for the division that became Enron Broadband. We spoke on Zoom.
We were the only ones focused on broadband experiences, and broadband did include streaming media, did include interactive, dynamic meetings like this.
Before that, Enron created the modern-day markets for natural gas and electricity, setting the course for how energy is priced to this day. Energy markets expert Ed Hurst, who worked with prosecutors to build their cases against company executives, concedes that Enron was a pioneer.
Did Enron revolutionize trading for natural gas and electricity? Without question. Brought liquidity, brought benefits to consumers and producers.
Which is why when Enron went bankrupt, throwing thousands out of work in a matter of hours, many mourned more than just a job. Ravi Katuria was a director at Enron's retail energy division.
Everyone inside the company acted almost like an entrepreneur. You're an internal entrepreneur and you were responsible for your destiny.
High pressure, but worth it, says Stephen Webster. He traveled the world as a young executive in the international division.
I would tell you it was probably one of the best jobs I ever had.
All well and good, according to Leslie Caldwell, who was the first director of the Justice Department's elite Enron task force formed in 2002. But she says that while Enron may have had some great ideas, they tried to monetize them before they were ready. And that's where she says the fraud came in. Even the Enron true believers here in Houston, and there still are many, concede that the company made some serious mistakes, chief among them pursuing growth over stability. Guys, by the way, Faber, you have not aged. I don't get it.
Oh, please, the two of you, it's ridiculous. I like the tie I was wearing. Scott, listen, you were there, we were there talking about this 20 years ago. You had incredible coverage. I mean, I'd love to get your sense. You talk about it being a complex legacy, and in fact, I think there are very few people other than you and a handful of others who could actually tell us exactly what they did that was the accounting center of the accounting fraud. But Just give me your perspective, 20 years later on this.
Yeah, well, I mean, it's interesting because here we are 20 years later, and I've been covering the Theranos trial in Silicon Valley. That's a different sort of situation, a different sort of company. When you look at Enron and you look back, this was a company that had a ton of brain power. It did have real businesses. The question is, where did they cross the line in terms of telling that story to Wall Street and telling it to the investment public? Of course, a lot of people went to prison over that or pleaded guilty and so on. But there were real innovations that came out of this company. Chief among them, the way that energy is traded to this day, natural gas trading, that came out of the so-called gas bank that was developed by Jeff Skilling, who also served a dozen years in prison. That's why we say that the legacy is complex, because there are some genuine innovations that came out of this company, legitimate innovations. The question is how they told the world about them and how they've translated that to the finances.
Yeah, obviously something else, as you pointed out, was the number of convictions. People went to jail. It was unlike, frankly, the financial crisis or what we're seeing today in terms of any corporate fraud that may be there. And it was followed 6 months later by WorldCom, where we also saw jail time and legislation, of course, as well, Scott. I mean, a lot did come out of this, and certainly it does seem to be sort of identified as a period when people actually were held accountable.
Yeah, and one of the big things that came out of it, of course, and you just referenced it, is Sarbanes-Oxley, the big accounting reform law that mandated things like auditor independence and company executives personally attesting to the financial statements. Those things came of it. Leslie Caldwell says that the aggressive tactics that task force employed against Enron executives, that helped create more accountability. There's a whole lot of bitterness among people that interacted with the task force. Still to this day here in Houston, Leslie Caldwell and her team, they were mob prosecutors. And that was something we hadn't really seen before, where they were employing those kinds of tactics against business people. She says that it was absolutely appropriate and that it cleaned things up. And here she is now, a criminal defense attorney. So she's on the other side of the table now. But she and others say that it did create accountability. Again, you'd get a lot of dispute about that here in Houston.
Yeah, finally, Scott, Arthur Andersen, I mean, you mentioned accounting, of course. There's still a lot of people who are also bitter about that and how quickly that company was taken down by the Department of Justice.
Yeah, and remember, that was an accounting firm with 85,000 employees. They were convicted of obstruction of justice in the Enron issue, and that conviction was overturned by the Supreme Court, but too late because the company went out of business. I asked Leslie Caldwell about that, and she said her great regret about it is not that they went after Arthur Andersen, but that Arthur Andersen didn't take a deferred prosecution deal that the Justice Department was offering that might have kept the firm alive and yet created some accountability for this alleged obstruction. Andersen had had issues before in waste management, their accounting firm there, and the Justice Department took the position that Andersen was kind of on its last strike when it came to Enron. The Supreme Court again overturned that, and so it was a really difficult thing for one small slice of that company, then putting 85,000 people out of work, and add insult to injury, then the conviction is overturned.
And real quickly, Scott, obviously the key players, Ken Lay passed away prior to actually even, I think, going to trial, if I recall. Skilling, Fastow, where are they now?
So Lay died after he was convicted, and so the convictions were then wiped out. Skilling is back in Houston. He did 12 years in prison, the longest out of any of the Enron executives. He is now doing a startup, a high-tech firm in the energy industry, keeping a low profile. He declined to comment for our reporting today. Andy Fastow served 5 years in prison. He pleaded guilty and testified against both Skilling and Lay. He's been on the lecture circuit talking about corporate ethics and the issue of following the rules versus the principles. He says he did too much of the former and not enough of the latter, and has accepted his guilt, and that's what he goes out and talks about to this day.
Scott, appreciate your insight today, and of course all your incredible reporting. Can't believe it is 20 years. Thank you.
We are getting word from the Minnesota Department of Health that they have confirmed their first Omicron variant case. An adult male had been vaccinated, mild symptoms on the 22nd of the month. The symptoms have resolved. He had traveled to New York City and attended a conference at the Javits Center from November 19 to 21. We're seeing actually a little bit of buying despite that news. Oil's up a touch. Dow continues to hold 400 points to the upside. Meantime, Snowflake, C3 AI, and Okta on the move after reporting results. We've got the CEOs of all three coming up in the next hour. Tech Check. Don't go anywhere.
We still have bound CAD strong and OC CAD strong, OCN long. So basically we buy a strong currency against the weak currency.
Welcome back to Squawk on the Street. I'm Dominic Chu. As stocks move higher today, we are starting to see a little bit of slowing momentum. We want to take a look at some of the action in the consumer staple sector. As you can see behind me here, everything is in the green so far. Some of the hard-hit names in recent days are staging a and Cisco see there on a basis for, a week or so period. It's been a tough go. Kroger, by the way, leads the SP 500 today overall after the grocery store chain beat earnings estimates and raised its full-year financial guidance. Be sure, by the way, to tune into Closing Bell this afternoon for an exclusive interview with Kroger Chairman and CEO Rodney McMullen. Keep it right here. Watch those consumer staples. More Squawk on the Street ahead. Stay with us.
Welcome back to Squawk on the Street. Pandemic mortgage bailouts are ending, and that could mean thousands of homes hitting the market this winter. Diana Olick has that story for us. Diana.
That's right. In the last year and a half, nearly 8 million borrowers went into COVID mortgage relief programs, but just over half are now current again, and that's according to Black Knight. About a quarter of borrowers either sold their homes or refinanced their mortgages. More are still working with their lenders. But there are still about 264,000 homeowners who expired from their forbearance terms and are now delinquent, and 38,000 more already in active foreclosure. Now, the strange twist here is that unlike during the subprime mortgage crash, these borrowers have substantial equity in their homes, thanks to soaring home prices during the pandemic. Close to 3/4 of the borrowers in foreclosure have more than 20% equity, and just over a quarter have more than 50% equity, and that's according to Realty Track. That's those in foreclosure, but the shares are likely similar for those 264,000 who expired and are now delinquent but haven't yet reached foreclosure. In total, that could mean close to 300,000 likely lower-priced homes coming onto the market over the next 6 months. The question is whether the owners will decide to sell or wait out the foreclosure process. Margarita Diaz is a housing counselor in Putnam County, New York, who has been working with some of these borrowers.
They may have equity, but then it's a matter of where they're going. Where are they going to go? Where are they going to purchase? You know, things are so expensive. The market is high right now to purchase, and to rent too. That's a big problem.
And the current housing shortage is so bad, some estimate we need about 1 million more homes to meet demand. David?
Diana, thank you. Diana Olick. That'll do it for us on Squawk on the Street. Tech Check starts now.
Good Thursday morning. Welcome to Tech Check. I'm Carl Quintanilla with John Fort and Deirdre Bosa. Today, the Dow and the S&P bounced back. The NASDAQ not quite joining the rally. VIX is still above 29. S&P Tech, the only positive sector over the last month. Then, a slowdown in iPhone demand. Apple joins the rest of tech in this week's sell-off. We have an analyst who is still bullish. Plus, a trio of earnings interviews. We're joined by the CEOs of Snowflake, C3 AI, and Okta this hour, Dee.
Yeah, a big one. But let's kick off looking at the roller coaster ride markets have taken over the past week. The VIX down slightly from that massive spike at the end of trading yesterday, but still almost at 30 as the Dow and S&P rise for the first time in 3 sessions. The NASDAQ is trailing, though it has flipped into the positive. We'll call it flat for now. Software names have really fallen behind. In just the past month, growth names like Zoom, CrowdStrike, and Splunk all falling more than 20%. Our own Mike Santoli joins us now. Mike, NASDAQ sort of on the flat line, now turning slightly into negative, I should say. But what's been happening over the last few days has been interesting. If you want to blame Omicron, you might want to see the stay-at-home names catch a bid, but that hasn't really been the case. We mentioned Zoom at lows that we haven't seen since last year.
Exactly. It doesn't fit too neatly into this idea that we're just migrating back toward lockdown-type economics and privileging those stocks that did well during that period of time. I do think part of the reason for that is this new wrinkle in the economic outlook and the COVID outlook came as a lot of those stocks were really almost in liquidation mode. There'd been this period of time where people felt as if they were willing to give the benefit of the doubt to these, software type companies that were addressing huge markets. We know what happened. From January, really, you've had these lower waves of enthusiasm that's rolled through those areas. Now it's sort of like keeping it on a shorter leash. So a lot of it is the mechanics of portfolio managers and other investors, what they need or want to do near year end and how they're calibrating their bets. It seems like a lot of tax loss selling. It seems like a lot of a surrender on some of those growth stories. And also, I don't think there's a lot of folks out there willing to bet that we are going to really have behavior changes that goes back to, work from home, stay at home all the time. So that's why I think there's a little bit of complication in that neat storyline. And that's also why you haven't seen people really grab for those cyclical stocks that are going to do well if we reaccelerate. We're caught in between those two paths, I think.
Right. I think that there's maybe an assumption that things won't change too much here in the U.S., but it's still early, still hard to know what's going to happen internationally, right? And that could raise some of those supply chain problems, especially if countries, do institute new lockdowns or perhaps just, a bit more resistance to that reopening.
Right. And I think that really, in general, low conviction on all fronts in terms of how people are willing to place money behind any opinion about how this plays from here. That's why I do think in an information vacuum or this sort of foggy environment, people are just trimming back portfolios. One of the things that I think is hampering the market or has done so in the last few weeks is that we came into this period of the year with people pretty high equity allocations already, some indications we were heading toward the later part of the cycle, Fed maybe having to pay more attention to inflation. So the general idea is I'd rather lock it in after a good year than sort of let it ride for a year-end rally that seemed not to come on time.
Right, some profit taking at the end of the year, not a hard case to make. At the same time, Mike, to speak briefly about the market leadership, the mega cap tech names, which I look over the past week, haven't done a whole lot, though we are seeing Apple down 2.5% on those iPhone 13 reports, but still sort of the relatively safer space to be in terms of the market, certainly in terms of tech.
They absolutely have been. It's a relatively select group, I would have to say, and absolutely delivering you relative safety, if not outright gains during this period of time. Apple in particular, Microsoft to a lesser degree, and also the semiconductor stocks really haven't given up much of their leadership profile so far during this little bout of volatility.
All right, Mike, that's a good setup. I appreciate that. Mike Santoli on the broader markets. Let's turn specifically to Apple this morning. We were calling it a safe haven stock earlier in the week amid the sell-off, but getting pinched this morning on these reports of weak iPhone 13 demand, down more than 2%. Our next guest still likes the name in this volatile market, takes his price target up to a street high of 200. It's Wedbush Apple analyst Dan Ives. Dan, good morning to you. I'm not sure how many times we can sort of absorb these anonymously sourced supply chain stories about this name. You, in general, don't put much credence in them.
Look, I think there's a lot of ebbs and flows to the Apple supply chain. But at the end of the day, they overordered by about 8 to 10 million units going in. So I think this report, it kind of contradicts what we're seeing in terms of Asia supply chain checks, where it's stronger than expected. This is across from China in terms of demand perspective in U.S., and if the strongest holiday quarter Apple's ever had is weak, then call it weak. But to me, I think this is a stock that's on its way to $3 trillion market cap.
What takes you to 200, Dan? Is this a scenario where you would have to wait for the spring quarter, where we typically hear more about capital returns, or is it something else?
Well, it's really about services. I think services is a big part of the re-rating. We used to have about 1.5 trillion valuation to some of the parts, and that could be upwards of 80 billion going into next year. So I think that's something on the services going to continue to be strong. And then I look at the overall product cycle. I think it's the strongest product cycle we've seen out of Cupertino in over a decade. And even though we'll have these sort of gyrations and maybe some white knuckle periods, I ultimately think this is a stock with a 2 in front of it going into next year.
Dan, I don't see how this report even makes sense, the idea of demand weakness in the holiday quarter, given the supply constraints that Apple has guided to, that the market also reacted negatively to, by the way, and the lead times that we've continued to see, the checks that so many analysts have done. I don't get it. Do you get it?
Look, it's a bit of a head scratcher, to be honest, in terms of looking at it. But what I do think happened here is, as anyone's doing checks, that call it 8 to 10 million units, the fact that Apple's not reordering that, maybe being sort of mischaracterized as being weak. But ultimately, that was them just overordering for holiday, knowing a supply chain crunch was coming. I mean, I think based on our checks, this is about 40 million iPhone units they're going to do between Black Friday and holiday. And that'll be the strongest holiday quarter they've ever had. And that'll be about 10% above current street estimates. So there's going to be a lot of noise here, but we're continuing to buy on the dips here. And I think this is a stock that continues to move higher.
Yeah, and as you say it continues to march towards $3 trillion. In your opinion, Dan, services is a big part of that re-rating. But what do you make of App Store pressure? We haven't talked about it in a little bit, but it's definitely still there. You saw Google, about a month ago, take down its fees preemptive to any kind of regulation. How big is that risk?
Yeah, it's a golden goose for Apple when it comes to App Store. And I continue to focus on, despite Epic and what we've seen from a regulatory perspective, I mean, that's a pretty strong competitive moat. Around the edges, there could be some pressures, but it's going to be north of what I think is $80 billion going into next year. And that's a big part of the re-rating. If I go back the last 18, 20 months, I think going into the street was assigning a $200-300 billion valuation for services. And we think that's worth $1.5 trillion. And this is going to be a situation where the haters, they'll hate it at $1 trillion, despise it at $2 trillion. And then when it's $3 trillion, they'll be yelling out into an empty cars.
Hey, Dan, finally, longer term, we've had a couple of weeks now to absorb those reports that Apple was accelerating its car program, specifically its autonomy car program. Yesterday, there's some work at Morgan Stanley. They're wondering whether or not that eventually turns the auto industry into a subscription model and makes Tesla the BlackBerry of mobility. What are your thoughts on that?
Well, I view it as it's a matter of when, not if. Apple gets into the EV, especially on autonomous. We think an Apple car by 2025. But this is not a zero-sum game. I mean, Tesla's going to continue to have an ironclad ownership of the market, but we view it as a $5 trillion green tidal wave, biggest transformation to the auto industry since 1950s. So I viewed just Apple throwing their hat in the ring as just another indication of where this market's moving. But we continue to believe that is going to happen. It's a matter of how and ultimately when, in terms of with a partner.
Dan, great to see you. Appreciate it. But important day to have you as well. Dan Ives.
Now, we've said growth names are falling, Apple falling. You know it's not falling. Snowflake up about 11% after smashing revenue expectations and issuing higher guidance through the end of the year. Joining us now in a CNBC exclusive, Snowflake's chairman and CEO and author of the upcoming book, Amp It Up, Frank Slootman. Frank, good to see you. Now, this quarter, I mean, I'm not into reporters congratulating on quarters, but given what we've seen growth names do, it's remarkable. You're up 110% year over year, and you had a 9-figure deal and 5 8-figure deals. Am I reading that right?
Yes, I think you are.
What is the difference that you're seeing? How are you able to get deal sizes that large over this period of time? What's the strategy that's allowed your sales force and your company to execute in that way above expectations?
Yeah, one really important observation here is that what we really do is enabling demand that we believe has just been pent up and really suffocated for a long period of time that really couldn't be manifested. And if you couple that with the bigger macro backdrop, that's just the whole move towards direct-to-consumer and digital transformation, data becoming so core, data operations becoming so core to how companies operate, then it's a perfect storm, a really potent cocktail for growth. So I don't want to get you the impression that like, oh, you guys are just hard-selling company. We're very much enabling our customers to do what they want to do, and they're on a journey and they're on a mission, and they're driving hard, for building that digital data-driven infrastructure.
What are the conditions right now that allow you to execute on that kind of growth, though, and will they continue? I mean, you're growing faster than the hyperscalers overall, and you seem to be growing at a pace that we're used to seeing with smaller companies. You're a pretty good size already. So give us some perspective on the expectations here, because you did raise your guide.
Yeah, well, what really happens is that, as enterprises and institutions get their data in the cloud, once they start migrating their databases, then all of a sudden, all the friction is gone. It's very, very easy to spin up new clusters, new warehouses, new workloads. You can run them, every night instead of once a month. You can over-provision them. There's all these things that all of a sudden become possible that weren't possible before because we had capacity limitations in the on-premise world. The cloud world, that all goes away. So it's just opening the lid letting genie out of the bottle, and people are free, to run as hard and as fast as they want, and you see that reflected in our revenue and in our consumption patterns. And these larger enterprise, larger customers, as they get deeper and deeper into that journey, they see more and more opportunities to take advantage of. So that's really what's driving this.
Now, conveniently, next month you've got a book coming out called Amp It Up on leading for hyper growth. I think maybe you could just put these results on the back of the jacket here, but give us a sense that this isn't your first company, not your first company that you've taken public. You talk in this book about declaring war on mediocrity. How is that different from what you see in Silicon Valley, perhaps in tech in general? There are a lot of ambitious and aggressive leaders out there.
One of the main theme is, how do you run a company with an extreme focus on the core mission? In other words, fight all the distractions, take up the energy, the intensity, the pace, the tempo, and really run an entire organization, every single person, every minute of today, driving with that energy and with that intensity. And that's really, really hard to do. Most people get distracted. They get sometimes infatuated with their own early successes. They want to do victory laps. They get very happy with themselves. All those things, you don't hear us, do victory laps. No matter how good the results are, we're always focused on the next thing and the next thing. And that mental attitude is really, really important if you want to stay alive and you want to. In other words, that's really that mental mindset. If you can just strap that on, you're going to be way ahead of most other people, because it's in Silicon Valley, as companies grow, they become very, very easily distracted, and pretty soon they're a mile wide and inch deep. The employees are swimming in glue, moving like molasses, and before you know it, you're in decline. And we've seen very proud big names in Silicon Valley over the years go by the wayside. Why does that happen, right? So culturally, something is amiss, and you want to fight that on a day-to-day basis if you're a leader in your company.
Yeah, it's hard to stay on top. Good advice, Frank. It's Deirdre, by the way. So what then is next for you guys? As John said, you have held up a lot better than some of those growth momentum pandemic peers. You're off your lows by about 90%. What is your appetite for M&A, especially as other names in this space remain far below their highs? Are valuations looking attractive to you? What's the next chapter? Is it growing organically or through some M&A activity?
Well, we're pretty active, buying companies and investing in companies, and we report on that as well. And I really view that as acquiring stem cells, right? It's really buying sort of the core of when there are skills or techniques or things we just don't have, and that we find it hard to grow ourselves. That's what we're going to go and buy. You won't see us do M&A because we're running out of market. We're not going to run out of market for a very long time. In the business that we're in. So it's much more tactical, much more looking for opportunities to really advance our own agenda in a lot of different technology domains where we feel like we don't have the critical mass or the depth. So that's what you'll see us do. We're not going to big M&A is extremely unlikely for a company like Snowflake.
Why is that? Why is big M&A unlikely? And, where do you stand in terms of valuations, as we have seen a lot of valuations in enterprise software, sort of the wind come out of their sails?
The valuations is all relative. When you have a big market cap yourself, then obviously you can afford, more pricey assets as well, right? So are things expensive? Yes, but we're expensive too. So it all becomes the same thing. But big M&A is driven by people running out of market typically, and big M&A is also super high risk. It's very distracting. So those are things you only do when you absolutely have to. And for us, that's really where we're really focused on executing our core mission. We're much more focused on attracting talent and building the company that way, because that's really the beating heart of a growing enterprise is talent.
Tell me one thing also about your strategy in go-to-market. You have a try it before you buy it option in your data marketplace, and you're doing some usage-based pricing as well. What's the impact on engagement there? How do you expect that to affect your continued velocity based on what you've seen so far?
That's actually a super important observation. Snowflake is completely based on a consumption model. We don't sell licenses and use rights and so on. So customers only pay what they consume. It's like putting gas in your tank. So you really lower the bar for people to get started with Snowflake, because they can just start with a handful of files, ingest them, run some workloads, and they pay as they go. So you've really lowered the bar and the threshold for people to become productive. So a lot of the demand, if you will, that comes into Snowflake comes from the bottom up, where people are just trying things and experiencing things before they start signing contracts with us.
Well, not taking the victory lap, but the stock is doing some things this morning for sure. Frank Slootman, thank you.
Thank you.
Meantime, the CEOs of C3AI and Okta are coming up as we got the Dow at session highs. A big hour of Tech Check continues after this.
Okay, guys. Well, if you're trading the gold, you can trade between the line. If we're going higher, you can sell. If we're going down, you can buy. I mean, it's very easy strategy. Or if you can do a swing trade, like you can sell here, you target first target here and second target here. So you can do swing. If you are under the white zone, you go short. Your first target, second target. If you go long, first target, second target. Or you can just play the zone, white zone. If you trade below it, you go short, you put your stop loss above. And you shoot for target 1, target 2. So either way, you can do. Yesterday we did 443, 405, 461, and one minus $10. So it was a good day and a good month so far. We did this month 1735. Like I said, we usually shoot for 15,000 a month. So we did 1735 for last 2 days. And that's it for New York session. And I will talk to you later on Asia. Have a good day, guys. Take care.